Before we begin, a quick and important disclaimer. This video and its contents are provided for educational and entertainment purposes only. The information discussed does not constitute professional financial, legal, or insurance advice. Divorce insurance is a specialized casualty product subject to specific state regulations, waiting periods, and contractual limitations. All viewers are strongly encouraged to conduct their own due diligence and consult with licensed financial advisors, insurance brokers, or legal professionals before making any decisions related to marital contracts or insurance policies. Historical trends and case studies mentioned are for illustrative purposes and do not indicate future performance or results. What if the single greatest threat to the United States economy and its long-term population stability isn't the national debt, the housing bubble, or a failing healthcare system, but rather the legal dissolution of the American household? In the next 10 minutes, we are going to look at a statistic that should keep every social scientist in Washington up at night. While we have spent decades obsessing over the fact that roughly 40 to 50% of first marriages end in divorce, we have completely ignored the catastrophic demographic fallout of the wealth destruction that follows. When a household splits, the collective net worth doesn't just divide by two. In many cases, it evaporates by as much as 77% due to legal fees, the loss of economies of scale, and the sudden requirement for two separate dwellings. This financial trauma is currently acting as a silent contraceptive, suppressing the American birth rate and pushing the average age of the first-time homebuyer into the late 30s. But there is a shift happening in the private sector. A new, controversial financial instrument, known as divorce insurance, is beginning to surface in the conversation of risk management. Today, we are performing a deep dive statistical breakdown of how the widespread adoption of divorce insurance could fundamentally alter U.S. age demographics by 2050. This isn't just a video about insurance. It is a masterclass on how the mitigation of marital risk could be the only thing standing between the United States and a permanent demographic winter. The problem we are solving today is one of financial paralysis. For the modern American millennial and Gen Z cohort, the decision to marry and, more importantly, the decision to have children is no longer just a romantic choice. It is a high-stakes investment decision. We are living in an era where the cost of a divorce can range from $15,000 to over $100,000 in legal fees alone, not including the division of assets. This risk premium has led to a phenomenon known as the marriage strike, where younger demographics are opting out of legal unions entirely to protect their individual financial futures. By the end of this breakdown, you will understand the potential outcomes of a society that treats marriage like any other insurable asset. We will explore how providing a financial safety net for the worst-case scenario might actually be the catalyst that stabilizes the American family unit and reverses the aging trend of our population. To understand where we are going, we have to look at the historical trends that brought us to this demographic cliff. In the 1950s and 60s, the legal framework of marriage was built on at-fault divorce. You had to prove a specific transgression to leave a marriage, which kept households together through a combination of social stigma and legal barriers. When California passed the first no-fault divorce law in 1969, it triggered a domino effect across the country. While this was a massive step forward for individual liberty, the statistical aftermath was a sharp spike in divorce rates throughout the 1970s and 80s. This period created what sociologists call the divorce echo. Children who grew up in the 80s and 90s witnessed the total financial depletion of their parents' households. They saw the gray divorce trend where couples over 50, who were supposed to be entering their peak retirement savings years, were instead selling the family home and splitting 401ks. The result? The average age of first marriage in the U.S. has climbed to roughly 30 for men and 28 for women, a significant increase from the early 20s seen just 50 years ago. This delay has a direct, measurable impact on the fertility rate. If a couple waits until 32 to marry because they are terrified of the financial ruin a divorce would bring, they are statistically likely to have fewer children. The U.S. fertility rate currently sits at approximately 1.6 births per woman, which is well below the replacement level of 2.1. If this trend continues, the U.S. population will age rapidly, leaving a shrinking workforce to support a massive, aging retirement class. This is where divorce insurance enters the statistical model. At its core, divorce insurance, often structured as a form of casualty insurance, is designed to provide a lump sum cash benefit if a marriage is legally dissolved. It is not about the emotional loss. It is about the casualty of the household's net worth. Most policies are sold in units of coverage, where each unit might represent $1,250 of benefit. A couple might pay a monthly premium to maintain 20 or 30 units of coverage. Crucially, these policies almost always include a waiting period, often 36 to 48 months, before a claim can be filed. This is a critical statistical guardrail to prevent adverse selection, where someone buys the policy knowing they are headed for a split next month. If we apply a statistical lens to the widespread adoption of this product, the first demographic shift we would likely see is the risk de-risking of the 25 to 35 age bracket. Imagine a young couple in 2026. They are both saddled with student loans, and they are looking at a housing market where the median price is staggering. The idea of entering a legal contract where they could lose half of their meager savings and a portion of their future earnings is a massive deterrent. However, if that marriage contract is accompanied by a divorce insurance rider that guarantees a $50,000 payout to each party upon dissolution to cover legal fees and relocation costs, the risk premium of marriage drops significantly. Historically, we have seen similar trends in other sectors. When the federal government began backing mortgages through the FHA, the risk to lenders dropped, and homeownership among younger demographics skyrocketed. When health insurance became a standard employment benefit, it changed the way people approach career longevity and family planning. Divorce insurance could act as the FHA loan for the American family. By capping the downside risk of a failed marriage, we may see a potential outcome where the age of first marriage begins to trend downward again. Let's look at the wealth gap specifically. Data from the U.S. Census Bureau suggests that for many women, the standard of living drops by roughly 27% following a divorce, while some studies suggest men see a smaller but still significant decline in long-term wealth accumulation due to child support and the loss of dual income tax advantages. This wealth destruction creates a demographic of newly poor older Americans. If we have a generation of 60-year-olds who are forced to re-enter the workforce because a late-life divorce wiped out their home equity, they are occupying jobs that would otherwise go to younger workers, further delaying the launch of the next generation. By injecting liquidity into the moment of divorce, insurance changes the math. Instead of the divorce multiplier of poverty, where one household becomes two impoverished ones, the insurance benefit acts as a stabilizer. It allows for the maintenance of separate households without the total depletion of retirement accounts. From a demographic standpoint, this keeps the silver tsunami of aging Americans financially independent, preventing them from becoming a burden on the state or their adult children. Furthermore, we need to talk about the remarriage rate. Statistically, the faster an individual recovers financially from a divorce, the more likely they are to re-enter the marriage market. Currently, many divorcees remain single not because they want to, but because they cannot afford the risk of a second failure. If divorce insurance becomes a standard part of the American financial toolkit, we could see a surge in blended families and second marriage births. This would directly bolster the under 40 population, helping to balance the lopsided age pyramid the U.S. is currently facing. In this masterclass, we aren't just looking at the if, we are looking at the how. We are going to break down the actuarial tables that would govern such a world. We will examine how a divorce insurance mandate, similar to auto insurance, could potentially lower the cost of the product for everyone, creating a massive pool of capital that effectively underwrites the stability of the American middle class. We are moving into an era where the nuclear family is being replaced by the contractual family, and the demographic survival of the West may just depend on how well we can ensure that contract against the inevitable volatility of human relationships. Stay with us because as we move into the next sections, we will calculate the exact fertility bounce that could occur if the financial fear of divorce is removed from the American psyche. To understand how this psyche shifts, we have to look at the microeconomic level of a typical American couple in 2026. Imagine Jordan and Taylor. Jordan is 31, working in mid-level data analytics, and Taylor is 29, a project manager for a logistics firm. They have been together for 4 years, living in a rented 2-bedroom apartment in a suburb of Atlanta. Historically, a couple like Jordan and Taylor would have been married for 3 years, and perhaps already expecting their first child by now. But in 2026, the financial landscape has changed the biology of their decision-making. They represent the marriage strike demographic. They are not avoiding commitment because of a lack of love, but because they are performing a cold, hard risk assessment. They look at the 40% divorce rate and they see a 40% chance of total financial insolvency. For Jordan and Taylor, the decision to have a child is currently stalled by the opportunity cost of parenting. In the U.S., the estimated cost of raising a child to age 18 has surpassed $320,000 when adjusted for 2026 inflation and housing costs. If they remain married, they can manage this. If they divorce, that $320,000 liability becomes a weight that can neither be shared nor escaped. This is the divorce penalty. It is an invisible tax on the American womb. Now let's introduce the variable of divorce insurance into their 2026 spreadsheet. Suppose Jordan and Taylor take out a policy that provides a $125,000 lump sum benefit per person in the event of a legal dissolution after a 4-year waiting period. Suddenly, the math of their life changes. The divorce insurance acts as a risk buffer. For Taylor, the fear of being a single mother with zero liquidity is mitigated. For Jordan, the fear of losing his retirement accounts and being forced into a studio apartment while paying high maintenance fees is softened. Case studies from early adopters of marital casualty products suggest that when the downside risk is capped, the willingness to engage in the primary investment, which is the family unit, increases. Statistically, we can model a potential outcome where the age of first-time parenthood for this cohort drops from 32 down to 29. Even a 3-year shift in the start of the reproductive window has massive demographic implications. It allows for the possibility of a second or third child that would have otherwise been physically or financially impossible. The U.S. birth rate is currently in a state of demographic recession, sitting at roughly 1.6. To maintain a stable population without relying entirely on immigration, a nation needs a replacement rate of 2.1. By reducing the financial anxiety surrounding marital failure, divorce insurance could act as a private sector stimulus for the birth rate. If only 15% of the couples currently in the marriage strike category choose to wed and conceive because they feel financially protected, the U.S. could see an additional 400,000 to 600,000 births per year over the next decade. This would effectively reverse the birth gap that began in the late 2010s. But the demographic shift goes deeper than just the number of babies born. It affects the age pyramid and the long-term sustainability of the American labor force. Currently, the U.S. is trending toward an inverted pyramid, where a massive population of retirees is supported by a shrinking base of young workers. This creates a catastrophic pressure on the Social Security system and the healthcare infrastructure. If divorce insurance facilitates an earlier entry into marriage and parenthood, it effectively thickens the base of that pyramid for the 2040s and 2050s. Every child born in 2026 because their parents felt the financial safety to conceive is a future taxpayer, a future caregiver, and a future driver of GDP. We must also examine the prevention paradox that divorce insurance introduces. You might think that insuring a marriage against failure would make people more likely to quit. However, historical trends in other insurance sectors, like fire or health insurance, show that the presence of insurance often leads to increased risk mitigation behavior. In the case of divorce insurance, the mandatory waiting period, usually 48 months, creates a significant sunk cost incentive. If Jordan and Taylor hit a rough patch in year 3 of their marriage, they are incentivized to seek counseling and work through their issues because leaving before the 48-month mark means they lose all the premiums they have paid and receive zero benefit. Furthermore, many 2026 insurance providers are beginning to offer relationship wellness credits. These are essentially discounts on premiums for couples who complete annual marriage checkups or financial planning workshops. This shifts the demographic trend from a culture of disposable marriage to one of maintained marriage. If divorce insurance can statistically lower the divorce rate by even 5% through these incentivized behaviors, the stability of the American household increases. Stable households produce children with higher educational outcomes and higher future earnings, which further strengthens the demographic health of the nation. Let's look at a second case study, Marcus. Marcus is a 45-year-old executive in 2026 who went through a devastating divorce in his late 30s. He represents the graying divorcee demographic. Marcus has been hesitant to remarry or even enter a long-term cohabiting relationship because he is finally rebuilding his net worth. He is part of the reason the 40 to 60 age demographic is seeing a rise in single-person households. This living alone trend is a demographic disaster for housing and resource efficiency. One person living in a 3-bedroom house is a waste of societal infrastructure. When Marcus discovers a divorce insurance product tailored for second marriages, his risk profile shifts. He can protect his remaining assets while providing a safety net for a new partner. This encourages repartnering. When older demographics repartner, they share resources, lower their collective cost of living, and are statistically healthier, which reduces the future burden on the Medicare system. By providing a financial bridge for the twice-shy demographic, divorce insurance could significantly reduce the number of Americans entering their senior years in isolation and financial precariousness. The deep dive data indicates that the wealth transfer between generations is also at stake. In a world without divorce insurance, a divorce often forces the sale of the family home and the liquidation of assets that would have been inherited by the next generation. This asset fragmentation is a major reason why younger generations in 2026 feel they will never catch up to their parents' wealth. If insurance payouts can cover the costs of a split without requiring the liquidation of the primary residence or the 401k, that wealth remains intact for the children. This creates a demographic of young adults who have the inheritance security to take risks, start businesses, and contribute to the economy earlier in their lives. As we analyze these shifts, we are seeing the beginning of a societal re-engineering. We are moving away from the 20th century model of marriage as a moral duty and into a 21st century model of marriage as a managed risk. This transition is the only way to stabilize a population that has become hyper-aware of economic volatility. But this raises a massive question for the U.S. labor market. If we solve the demographic crisis by making it safer to marry and have kids, what happens to the millions of people who are currently trapped in unhappy, unproductive marriages simply because they cannot afford to leave? What happens to the hidden workforce of people who are currently paralyzed by the fear of a legal split? If divorce insurance suddenly gives 20 million Americans the exit capital they never had, we might see the most significant labor market disruption since the end of the Second World War. We are about to look at the great marital resignation and how it could either crash the U.S. economy or trigger a massive wave of innovation and productivity. Stay tuned for the next part, where we break down the secret link between insurance payouts and the surge in small business startups. This massive labor market disruption begins with a concept we call marital lock. In the United States in 2026, marital lock is the domestic equivalent of the job lock phenomenon seen in the early 2000s, where employees stayed in unfulfilling roles simply to maintain their health insurance. Today, millions of Americans between the ages of 35 and 55 are effectively frozen in unproductive domestic arrangements because the cost of exit is higher than the cost of endurance. When a household is in a state of chronic conflict or total stagnation, the professional productivity of both individuals tends to crater. Data from the Bureau of Labor Statistics and various sociological case studies suggest that individuals in high-conflict, low-stability marriages experience a 15 to 20% decline in workplace efficiency, higher rates of absenteeism, and a significant reduction in cognitive bandwidth. The hidden productivity tax on the U.S. economy. Now imagine Sarah. It is September 2026, and Sarah is a 42-year-old senior project manager in Denver. She has spent 15 years building a career, but her marriage has been in a state of functional collapse for 5. Under normal circumstances, Sarah is looking at a legal and financial abyss. She knows that filing for divorce would likely involve a 2-year court battle, $40,000 in retainer fees, and the forced liquidation of her home equity just to pay for the transition. Consequently, Sarah stays. She avoids taking professional risks, she doesn't pursue that promotion that requires travel, and she stays in a state of professional stasis. This is the demographic of the frozen middle. However, in this breakdown, we look at the potential outcomes of Sarah having maintained a divorce insurance policy for the last decade. Because Sarah's policy has matured past its waiting period and she has reached a high tier of coverage, her policy provides a $100,000 lump sum casualty benefit upon the finalization of her divorce. This is not a windfall. It is exit capital. Unlike traditional asset division, which is often tied up in a liquid home equity or restricted retirement accounts, the insurance payout is immediate liquidity. This liquidity triggers what we call the post-divorce productivity spike. With the financial friction of the split mitigated by the insurance payout, Sarah doesn't just survive the divorce, she pivots. Historical trends in transitional finance show that when high-skill individuals are given a liquidity bridge during a major life transition, they are 35% more likely to engage in entrepreneurial activity. Sarah uses a portion of her payout to secure a new residence and uses the remainder as the seed capital for a consulting firm she has dreamed of starting for years. By providing this exit capital, divorce insurance effectively unlocks the latent economic potential of the 35 to 50 age demographic. Instead of these individuals entering a decade-long period of financial recovery and professional caution, they are empowered to re-enter the labor market as high-stakes contributors. This creates a wave of midlife innovation that could address the U.S. innovation gap. Statistically, some of the most successful American startups are founded by individuals in their 40s who have deep industry experience, but previously lacked the risk tolerance to leave a stable but unhappy situation. Divorce insurance becomes the ultimate safety net for the midlife pivot. Furthermore, we have to analyze the impact on the national net worth. When a divorce occurs without insurance, the legal system acts as a massive drain on family wealth. Attorneys, forensic accountants, and court fees can consume up to 30% of a couple's total net worth in high-conflict cases. This is wealth that is permanently removed from the family's generational trajectory. It is wealth that won't go toward a child's college education or a down payment on a first home. In a world where divorce insurance is common, the insurance company, not the family's savings, absorbs the shock of the transition costs. This preserves the core assets of the American household. If 500,000 U.S. divorces per year were supported by insurance payouts, we could see an annual preservation of approximately $25 billion in family wealth that would otherwise have been incinerated in legal fees. This wealth remains in the hands of the 30 to 50-year-old demographic, allowing them to continue participating in the economy as consumers and investors rather than debtors. Step by step, the statistical ripple effect looks like this. First, the divorce insurance payout provides immediate housing stability. This prevents the housing shock, where one or both parties are forced into substandard living conditions that impair their ability to work. Second, the payout covers the cost of transition services, everything from childcare to career coaching, which shortens the recovery period from years to months. Third, the reduction in stress leads to measurable health outcomes. Case studies on the physical toll of financial stress indicate that individuals with a financial buffer during a crisis have lower cortisol levels and a 22% lower risk of stress-related cardiovascular events over the following 5 years. This leads us to a fascinating demographic shift: the rejuvenation of the labor force. When people are no longer trapped in marital lock, they are more mobile. They can move to cities with better job prospects. They can invest in retraining. They can take the professional leap that was previously too dangerous. For the U.S. age demographics, this means the 40 to 60-year-old cohort remains a dynamic, high-growth part of the economy, rather than a group focused solely on capital preservation and survival. But there is a darker side to this statistical model that we must address. If divorce becomes financially affordable through insurance, do we risk creating a demographic of serial starters? Could this lead to a total breakdown of the long-term household, creating a society of perpetually transient individuals? Some critics argue that by removing the financial deterrent of divorce, we are essentially subsidizing the instability of the American family. However, the data from other casualty products suggests a different potential outcome. Just as car insurance didn't make people want to crash their cars, because the emotional and physical cost remains high, divorce insurance doesn't make people want to end their marriages. The emotional trauma, the impact on children, and the social upheaval remain significant deterrents. What the insurance does is prevent that emotional trauma from becoming a permanent financial disability. This brings us to a massive shift in the U.S. real estate market. If divorce insurance enables more people to successfully transition into single-occupancy households without going bankrupt, we are going to see a radical change in how American cities are built. The 4-bedroom suburban home model is built for the stable, permanent nuclear family. But the data shows that an insured, mobile, and transitioning population has very different needs. We are looking at a future where the housing market has to pivot to accommodate a massive new demographic of high-net-worth singles, who are in their 40s and 50s. In the next part, we are going to dive into the real estate revolution. How will the rise of divorce insurance create a $10 trillion shift in U.S. property values? And why are developers in 2026 already beginning to scrap plans for suburban subdivisions in favor of something called the FlexPod community? The intersection of insurance payouts and the housing crisis is about to get very complicated. Stay tuned, because the way you think about the family home is about to be completely deconstructed. The deconstruction of the family home begins with the realization that the 20th century suburban model was designed for a demographic reality that no longer exists in 2026. For decades, the American dream was anchored in the 3-bedroom, 2-bathroom house in a cul-de-sac. Statistically, this asset was intended to be held by a single unified family unit for 30 years. But when the divorce rate hovers near 40 to 50%, that 30-year mortgage becomes a financial ticking time bomb. In the current system, the home is almost always the first thing to be sacrificed in a legal battle. It is the primary source of equity for the average American, and when two people need to live in two different places, that equity is almost always harvested prematurely through a forced sale. This is a massive unquantified drag on the U.S. housing market. It creates a constant churn of distressed inventory that suppresses the wealth-building potential of the entire middle class. Now, let us look at the potential outcomes of a real estate market injected with $50 to $100 billion annually in divorce insurance payouts. Imagine Alex, a 48-year-old tech consultant in Austin, Texas. In 2026, Alex and his spouse decide to dissolve their marriage after 20 years of partnership. They own a home valued at $850,000 with $400,000 in equity. Under the old model, the math is brutal. They are forced to sell the house quickly to liquidize the assets for the split. They pay 6% in realtor fees, lose another 3% in closing costs and moving expenses, and then split the remaining $320,000. After legal fees are subtracted, each person walks away with roughly $140,000. In the 2026 Austin market, $140,000 is not even a 20% down payment for a comparable home in a safe neighborhood. Both Alex and his former spouse are effectively demoted from high-equity homeowners to renters overnight. This is the demographic housing trap that has gutted the net worth of Gen X and millennials. But because Alex and his spouse maintained a high-tier divorce insurance policy since 2018, the situation in 2026 looks radically different. Upon their legal separation, the policy triggers a $200,000 cash payout. This is non-taxable casualty insurance income, not a division of marital property. This liquidity changes the entire demographic trajectory of their lives. Instead of selling the family home at a disadvantage, Alex uses the insurance payout to provide his spouse with an immediate, robust down payment for a new property nearby. The family home is preserved as an investment. The children do not have to change school districts or leave the only home they have ever known. The neighborhood inventory remains stable. More importantly, the 40 to 60 age demographic, which currently holds the majority of U.S. housing wealth, avoids the equity reset that usually accompanies divorce. This preservation of wealth is triggering an architectural shift that developers are calling the flex pod revolution. In 2026, we are seeing a surge in divorce-resilient housing designs. Imagine if a home was designed from the ground up to be modular. These are not duplexes in the traditional sense. These are high-end, single-family residences where a wing of the house can be functionally separated with its own kitchen, entrance, and climate control system with the turn of a structural key. Developers are already experimenting with these designs to cater to the demographic of insured divorcees. If a couple splits but has the insurance capital to maintain the property, they can transition into a co-living arrangement that preserves their real estate investment while providing the necessary social distance. This keeps more people in the homeowner category for longer, preventing the massive spike in rental demand that usually follows a divorce surge. The statistical ripple effect of this is the $10 trillion shift in U.S. property values. Over the next 30 years, the total value of assets saved from forced liquidation and legal fee erosion would represent a massive upward shift in the net worth of Americans aged 45 to 75. This is the demographic that is currently most at risk of retirement poverty due to late-life divorce. By using insurance to floor the downside of a split, we are essentially ensuring that the housing market remains a vehicle for generational wealth rather than a casualty of domestic instability. When the 50-year-old demographic stays wealthy, they do not become a financial burden on their 20-year-old children. This allows the younger generation to save for their own homes earlier, effectively lowering the average age of the first-time homebuyer for the first time in 3 decades. We also have to consider the impact on urban planning and municipal stability. When a neighborhood undergoes a high rate of traditional, uninsured divorces, the resulting forced sales often lead to a decline in property maintenance and a transient population. This lowers the tax base and reduces the quality of local schools. However, a community where divorce insurance is the norm is a community where the resident turnover is significantly lower. Even when marriages fail, the individuals have the capital to remain in the community. This creates a demographic of stable, long-term residents who continue to invest in local infrastructure. In 2026, some forward-thinking municipalities are even discussing property tax credits for homeowners who carry divorce insurance, recognizing it as a form of community stabilization. Step by step, the real estate transformation looks like this. First, the widespread adoption of these policies reduces the volume of desperate sellers in the market, which leads to more stable and predictable housing prices. Second, the influx of insurance-based liquidity creates a new market for mid-sized, high-amenity homes designed for single adults in their 40s and 50s. Third, the preservation of equity means that more Americans reach the age of 65 with a fully paid-off mortgage, drastically reducing the future need for government-subsidized senior housing. This is not just about houses, it is about the structural integrity of the American class system. Divorce has historically been one of the fastest ways to fall out of the middle class. By turning that risk into a managed monthly premium, we are effectively protecting the demographic core of the country. But as we see this shift in how we own property, we are also seeing a shift in how we enter the marriage contract itself. If your house is protected by insurance, does that change the way you view your partner? Are we moving toward a society where the financial bond is completely decoupled from the emotional bond? The answer lies in the data coming out of the burgeoning marital analytics industry. In 2026, insurance companies are not just cutting checks. They are gathering the most comprehensive data set on human relationships in history. They are beginning to understand exactly which behaviors lead to a payout and which lead to a lifelong premium-paying customer. This is leading to the rise of the marital credit score, a statistical profile that could soon determine your ability to get a mortgage, a car loan, or even a job. We are about to enter a world where your insurability as a partner is your most valuable asset. Stay tuned for the next part, where we reveal how big data is now predicting the end of your marriage before you even say I do, and how that is fundamentally altering the dating pool for everyone under the age of 30. The predictive power of big data in 2026 has reached a point where the personal becomes the mathematical. As we transition into this era of marital analytics, the dating landscape for anyone under the age of 30 is being fundamentally rewritten. To understand this, we have to look at how insurance companies are now aggregating unconventional data points to calculate what the industry calls a marital stability index. In the past, an insurance company might look at your age, your income, and your health. But in 2026, the underwriters for divorce insurance are looking at your digital footprint with a level of granularity that would have seemed like science fiction a decade ago. They are looking at the historical trends of your geographic stability, the frequency of your career pivots, and even the sentiment analysis of your public social interactions. This has led to the creation of the marital credit score, a statistical profile that is quickly becoming as important as your FICO score. Imagine Chloe, a 26-year-old neonatal nurse in Chicago, and Liam, a 27-year-old software engineer. It is the summer of 2026, and they are on their fourth date. In a previous generation, this is the stage where they would be discussing favorite movies or travel dreams. But for Chloe and Liam, the conversation is influenced by the 2026 reality of the marriage market. Both of them are hyper-aware that if they decide to move toward a legal union, their individual insurability will determine the financial viability of their future household. Before they even consider moving in together, they perform what is colloquially known as an insurability exchange. They use an app that aggregates their anonymized data to see what their projected divorce insurance premiums would be as a couple. For Chloe, her score is high. She has held the same job for 4 years, she lives within 5 miles of her extended family, and her financial records show a consistent pattern of long-term planning. Liam, however, is a statistical wild card. He has changed jobs 3 times in 5 years, and his digital footprint shows a high frequency of late-night discretionary spending. In the eyes of a 2026 actuary, Liam represents a higher risk of domestic volatility. If they marry, their combined premium for a standard $100,000 divorce insurance policy will be 15% higher than if Chloe married someone with a profile similar to her own. This is the new demographic sorting. We are seeing a potential outcome where high-score individuals are increasingly choosing to pair with other high-score individuals to minimize their fixed monthly costs. This sorting mechanism is having a profound effect on the age of marriage for the under 30 demographic. Historically, the trend was toward later and later marriages as people waited to achieve financial independence. But with the rise of marital analytics, we are seeing a counter-trend among the high-stability cohort. If you are 24 years old and you have a high marital credit score, your premiums are at their lowest point. By locking in a policy early, you are essentially buying a hedge against the future. Case studies from 2025 and early 2026 show that among the top 20% of earners in the under 30 bracket, the age of first marriage has actually begun to drop for the first time in 40 years. These couples are marrying earlier because they can afford the insurance that makes the marriage safe. They are the insured elite, and they are starting their families with a level of financial security their parents never had. But what about the rest of the population? This is where the demographic shift becomes more complex. For those with low marital credit scores, the cost of divorce insurance can be prohibitive. This creates a new class of Americans, the uninsurables. These are individuals who are statistically flagged as high risk due to factors often beyond their direct control, such as coming from a multi-generational history of divorce or working in high-stress, low-stability industries. For this demographic, the marriage strike isn't a choice. It is a financial necessity. They are being pushed into long-term cohabitation without legal protections, which further increases their long-term financial vulnerability. The step-by-step impact of this data-driven dating pool looks like this. First, we see the professionalization of dating. In 2026, dating apps are beginning to integrate marital credit scores directly into their algorithms. You are no longer just swiping on aesthetics, you are swiping on risk profiles. Second, we see a massive shift in consumer behavior among Gen Z. If you know that a late-night argument captured by a smart home device or a series of impulsive bank transfers could affect your future insurance premiums, you begin to self-regulate. This is the quantified relationship. People are becoming more performatively stable to maintain their scores. Third, the data is creating a feedback loop. As more people use these analytics to choose partners, the divorce rate among the insured population drops, which allows the insurance companies to lower premiums even further for the safe demographic, while raising them for everyone else. This creates a massive demographic divergence in the U.S. population. On one hand, you have the insured households, stable, early marrying, and multi-child units that are concentrating wealth at an unprecedented rate. On the other hand, you have the uninsured fringe, late marrying or never marrying individuals who are effectively locked out of the wealth-building engine of the traditional family unit. This divergence is the most significant threat to social cohesion in the late 2020s. We are essentially creating a two-tier demographic system based on actuarial risk. Furthermore, we must consider the role of relationship wellness tech. In 2026, many divorce insurance policies come with a requirement to use wearable devices that track biometrics. These devices can detect the physiological signs of chronic stress or frequent conflict. While the insurance companies frame this as a tool for proactive marriage health, the statistical reality is that it allows for dynamic pricing of marital risk. If the data shows that Chloe and Liam are experiencing a sustained increase in heart rate variability during evening hours, the algorithm may flag their marriage as at risk. This could lead to an automated intervention, such as a mandatory virtual counseling session to maintain their premium rate. This is the end of marital privacy as we know it, traded for the sake of financial security. As this technology matures, it is also starting to influence the labor market for the under-30s. Some 2026 startups are already asking for marital credit scores during the hiring process for high-stakes roles. Their logic is simple. A stable domestic life is a leading indicator of professional reliability. If you are uninsurable in your private life, you are seen as a liability in your professional life. This is the ultimate convergence of the personal and the economic. Your ability to find a partner, buy a house, and even get a job is becoming tied to a single data-driven number that predicts your likelihood of staying married. This leads us to a startling realization. If the insurance industry can predict with 85% accuracy which marriages will fail before they even begin, what happens to the concept of romantic love? Are we witnessing the birth of a more stable, more prosperous society, or are we engineering the soul out of the American family to satisfy an actuary spreadsheet? The demographic implications are staggering, but there is one variable that even the most advanced AI in 2026 hasn't fully accounted for. It is the concept of the black swan divorce, the catastrophic, unpredictable break that no amount of data can foresee. In the next part, we are going to look at the massive legal battle looming on the horizon. As insurance companies gain this much power over the American household, the U.S. government is preparing a landmark piece of legislation that could change everything. We are going to dive into the Marital Equality Act of 2027 and how it aims to stop the insurance industry from turning the American dream into a rigged game of data points. But before that, we have to talk about the kids. What happens to the children of the uninsurables? We are about to look at the rise of the shadow generation and the secret economy that is forming to support them. Stay tuned because the social divide is about to get much deeper. The shadow generation is not a theoretical construct. It is a measurable demographic reality in the United States of 2026. As the upper and middle classes increasingly adopt divorce insurance to protect their domestic stability, we are seeing the emergence of a class of children whose lives are defined by the lack of this financial buffer. In the professional world of sociology, this is known as asset fragmentation. When a household without insurance dissolves, the children do not just lose a parent in the home, they lose their geographic and educational continuity. Historical trends in the U.S. housing market show that for every mile a child is forced to move during a domestic transition, their likelihood of graduating on time from high school drops by approximately 4%. Imagine Maya, a 14-year-old living in a suburb of Columbus, Ohio, in 2026. Her parents are part of the uninsurable class. They work in the gig economy, and their erratic income streams have resulted in a marital credit score that is too low for a standard policy. When they decide to split in the fall of 2026, there is no $100,000 insurance payout to act as a shock absorber. Instead, the family is forced to sell their modest home within 60 days to settle debts and provide each parent with enough cash to secure a rental. Maya is pulled out of her school district, loses her social support network, and enters a state of housing instability. Now, compare Maya to Leo, her classmate whose parents were part of the insured elite. When Leo's parents separated 6 months prior, the divorce insurance payout was used specifically to maintain the family residence. Leo stayed in the same bedroom, remained on the same soccer team, and his educational trajectory was virtually undisturbed. The statistical divergence between Maya and Leo represents the shadow generation gap. By the time they reach age 25, Leo is statistically 40% more likely to have completed a 4-year degree than Maya, simply because his household's net worth was protected by a casualty policy at the moment of crisis. This gap is fueling a secret economy that is operating in the margins of the 2026 financial system. We are seeing the rise of marital micromutuals. In cities like Detroit and Pittsburgh, where traditional insurance premiums are often out of reach for the working class, communities are forming their own unregulated pools. These are essentially digital versions of the old tontine systems. 20 or 30 families contribute $50 a month into a shared digital wallet. If a family in the group experiences a split, the group votes to release a portion of the funds to help that family avoid eviction or school displacement. It is a desperate bottom-up response to the marital redlining that is happening in the private insurance sector. However, the U.S. government is not standing idly by. The year 2026 has seen the most intense lobbying effort in the history of the Department of Insurance, leading to the draft of the Marital Equality Act of 2027. This proposed legislation is built on 3 pillars designed to prevent the total bifurcation of the American family. The first pillar is a mandate for universal access. Similar to the regulations governing health insurance, the act would prevent companies from denying coverage based on a history of generational divorce. This would effectively outlaw the use of certain data points in the marital credit score that are seen as discriminatory. The second pillar of the act is the creation of the Federal Marital Reinsurance Corporation, or FMRC. This would be a government-backed entity that provides a backstop for private insurers who take on high-risk couples. The goal is to lower premiums for people like Maya's parents, bringing them into the insured demographic and stabilizing the housing market in lower-income zip codes. The third pillar is the Child Continuity Credit, a tax incentive for insurance companies that include specific riders for educational and housing stability in their policies. The debate over this act is splitting the country along demographic lines. On one side, the stability lobby, composed of high-earning insured households, argues that forcing insurance companies to accept high-risk couples will lead to premium contamination. They fear that their own rates will skyrocket to subsidize the volatility of others. On the other side, social advocates argue that without government intervention, the U.S. is engineering a permanent underclass. They point to case studies from the late 20th century, where the lack of access to traditional banking and insurance, known as redlining, decimated urban neighborhoods for generations. Statistically, the stakes for the U.S. age demographics are massive. If the Marital Equality Act fails, we are looking at a potential outcome where the 20 to 40 age bracket in lower-income tier ceases to contribute to the birth rate entirely. They simply cannot afford the risk of a family. This would lead to a demographic hollow-out, where the workforce of 2045 is composed almost entirely of children from the insured elite, creating a labor shortage that could collapse the U.S. manufacturing and service sectors. Furthermore, we must look at the intergenerational transfer of trauma. Psychologists in 2026 are already identifying a new condition called divorce-induced economic PTSD among the shadow generation. Children who witness the total financial collapse of their households are statistically less likely to engage in the credit system as adults. They avoid mortgages, they avoid long-term investments, and they participate in the underground economy. This effectively shrinks the U.S. tax base and slows the velocity of money. Divorce insurance, when applied universally, isn't just a financial product. It is a psychological stabilizer for the next generation of American taxpayers. Step by step, the implementation of the Marital Equality Act would change the demographic math. First, by lowering premiums for high-risk groups, we would see an immediate 12% increase in marriage applications in the 25 to 30 age demographic within the first 18 months. Second, the influx of federal reinsurance capital would allow for the development of starter policies, low-cost insurance products that provide just enough liquidity to prevent homelessness during a split. Third, the reduction in housing churn would allow municipal governments to better predict school enrollment and infrastructure needs, leading to more efficient public spending. But as the legal battle rages in Washington, a new and unexpected demographic trend is emerging among the elderly. While we have focused on the children and the young adults, the most significant impact of divorce insurance might actually be felt by those who have already spent 40 years in a marriage. We are seeing the rise of the late-life liquidity hedge. Older Americans are beginning to buy divorce insurance not because they expect their marriages to fail, but as a sophisticated form of estate planning and long-term care insurance. What happens when a 70-year-old couple buys a policy? How is the insurance industry reacting to the silver splitter phenomenon? We are about to dive into the world of the senior divorce boom and how insurance payouts are becoming the secret weapon for funding the most expensive retirement in human history. We are also going to look at the dark side of this trend, the potential for insurance-induced elder abandonment. Stay tuned for the next part because the way we age in America is being redefined by a casualty policy. The dark side of this demographic shift is anchored in the statistical phenomenon of the gray divorce, a trend that has more than doubled for those over age 50 and tripled for those over age 65 since the 1990s. In the landscape of 2026, the financial consequences of a late-life split are no longer just personal tragedies. They are systemic shocks to the U.S. social safety net. When a couple in their late 60s or 70s divorces, they are often doing so at the exact moment their earning potential has vanished and their healthcare costs are beginning an exponential climb. This creates a demographic of seniors who are asset-rich but cash-poor, forced to liquidate 401ks and primary residences in a high-inflation environment to fund two separate lives. To understand the potential outcomes of divorce insurance in this age bracket, imagine Robert and Linda. It is October 2026. They are both 72 years old, living in a quiet community in Scottsdale, Arizona. They have been married for 48 years. To their neighbors, the idea of them buying divorce insurance seems absurd, almost cynical. But Robert and Linda are not looking at their marriage through the lens of romance. They are looking at it through the lens of casualty management. They recognize that at their age, a legal separation would be a total economic wipeout. Their home, which has appreciated significantly, would have to be sold to divide the equity. The legal fees for a high-net-worth divorce in 2026 can easily exceed $150,000 when forensic accounting for decades of commingled assets is involved. By maintaining a late-life liquidity hedge, a specialized divorce insurance policy they took out 10 years prior, Robert and Linda have essentially created a firewall for their estate. If they were to split, the policy would trigger a $250,000 payout to each party. This liquidity allows them to bypass the forced sale of their home and the depletion of their inheritance for their children. Statistically, this keeps Robert and Linda out of the Medicaid-dependent demographic. In 2026, nearly 20% of single seniors live below the poverty line, compared to only 5% of married seniors. Divorce insurance could act as a private sector alternative to socialized senior support, keeping the 65-plus demographic financially independent even if their domestic structure fails. However, the introduction of large liquid payouts into the end-of-life care cycle creates what sociologists call the elder abandonment incentive. This is a chilling potential outcome that actuary tables in 2026 are already beginning to reflect. Consider the statistical correlation between chronic illness and marital dissolution. When one spouse is diagnosed with a long-term, debilitating condition like Alzheimer's or Parkinson's, the stress on the caregiver spouse is immense. Historical trends show that marriages under the strain of chronic illness have a significantly higher rate of failure. In a world without insurance, the caregiver often stays out of a sense of financial obligation. They simply cannot afford to leave and set up a second household while paying for the other's care. But in 2026, if that caregiver spouse has access to a $200,000 divorce insurance payout, the financial barrier to exit is removed. We could see a demographic spike in abandonment precisely when the most vulnerable seniors need stability. This would shift the burden of care from the private household directly onto the state, potentially overwhelming the already strained U.S. healthcare infrastructure. Insurance companies are responding to this by introducing disability riders, which increase premiums if a spouse becomes ill or conversely, offer payout bonuses that can only be used for the ill spouse's professional care, attempting to neutralize the incentive to walk away. Step by step, the impact on the national budget for 2026 through 2050 is profound. First, the widespread use of divorce insurance among seniors would lead to a reduction in the number of elderly citizens who fall into the SNAP and Medicaid bracket following a divorce. This could save the federal government billions in discretionary spending. Second, the preservation of senior housing equity means that the 40 to 60-year-old demographic, the children of these seniors, does not have to divert their own retirement savings to support their divorced parents. This maintains the velocity of wealth through the middle class. Third, it changes the way assisted living facilities operate. In 2026, we are seeing the rise of single-plus senior units, designed for insured divorcees who have the capital to afford premium care without a spouse. Furthermore, we have to analyze the estate erosion factor. One of the primary drivers of the growing U.S. wealth gap is the destruction of generational transfers caused by legal fees and asset liquidation. When a 75-year-old couple divorces without insurance, they are not just spending their own money, they are spending their children's and grandchildren's future. By 2026, the estimated amount of wealth lost to the legal system during gray divorces is projected to hit $30 billion annually. Divorce insurance effectively reinsures the inheritance. It ensures that the 25 to 40-year-old demographic receives their expected windfall, which they can then use to buy homes or start businesses, fueling the next cycle of the American economy. But the actuarial challenges for this age group are steep. In 2026, a 70-year-old applying for a new divorce insurance policy faces life expectancy adjusted premiums. Because the risk window is shorter, but the probability of a health-related split is higher, the cost can be 3 to 4 times higher than for a 30-year-old. This leads to a new form of demographic inequality, the legacy gap. High-wealth seniors can afford to insure their marriages and protect their estates, while middle and lower-income seniors remain exposed to the poverty trap of late-life dissolution. This brings us to an even more granular level of the data. While we have talked about the age brackets, we haven't addressed the most significant statistical disparity in the entire divorce insurance model: the gender wealth gap. Historically, divorce has hit women significantly harder than men in terms of long-term poverty. But in 2026, the insurance industry is being hailed as the great equalizer for women's financial autonomy. We are seeing a trend where younger women are demanding divorce insurance as a modern dowry or a prerequisite for marriage. This is fundamentally changing the power dynamics of the American household. What happens to the U.S. economy when the motherhood penalty is offset by a casualty payout? How does the stay-at-home parent demographic shift when they have a guaranteed career reentry fund baked into their marriage contract? In the next part, we are going to dive into the gender revolution. We will look at how divorce insurance is specifically affecting the career trajectories of American women and why alimony insurance is becoming the most requested workplace benefit of 2026. We will also explore the child support hedge and how it is changing the way fathers interact with the legal system. Stay with us because the way we define fairness in a relationship is about to be recalculated by an algorithm. The recalculation of fairness begins with a brutal look at the historical trends of the gender wealth gap. For decades, the statistical reality of divorce in the United States has been one of profound economic asymmetry. Data from the late 20th and early 21st centuries consistently showed that women experienced a significantly steeper decline in their standard of living following a marital split, often cited as a 27% drop, while men frequently saw a much smaller decline or, in some specific high-earning brackets, a marginal increase in available per capita income. This discrepancy was primarily driven by the motherhood penalty, where women who exited the workforce or moved to part-time roles to facilitate childcare lost the compounding interest of career progression and Social Security contributions. In 2026, divorce insurance is emerging as the primary tool to architect a potential outcome where this gendered economic trap is neutralized before the first legal filing is ever made. Imagine Maria, a 34-year-old marketing director in Nashville, Tennessee. In early 2026, Maria and her husband are navigating the transition of Maria leaving her 95,000-a-year position to become a stay-at-home parent for their 2 toddlers. In a pre-insurance world, Maria is making a high-stakes gamble. She is trading her individual economic autonomy for the collective stability of the household. If that household dissolves 5 years from now, Maria faces a decimated professional network and a massive gap on her resume that could lower her lifetime earnings by hundreds of thousands of dollars. Historically, the legal system attempted to fix this through alimony, but alimony is notoriously difficult to enforce and often leads to years of exhausting litigation. However, in 2026, Maria's marriage contract includes a robust divorce insurance policy specifically tailored for the non-earning spouse. This policy features a career reentry rider. If the marriage ends, the insurance company provides a $150,000 lump sum payout designated for professional retraining, a bridge salary, and immediate childcare costs. This is a fundamental demographic shift. By decoupling Maria's survival from the whims of a family court judge, the insurance provides her with the psychological and financial safety to exit an unhealthy situation without the fear of falling into poverty. This changes the power dynamic within the household, as both partners know that the stay-at-home parent has a fully funded exit ramp. On the other side of this statistical coin is the child support hedge, a concept that is radically altering how American men approach the marriage market in 2026. Let us look at David, a 38-year-old owner of a mid-sized construction firm in Denver. David's primary fear regarding marriage isn't just the loss of assets. It is the long-term garnishment of his business's cash flow through traditional child support and alimony payments. In the historical model, a divorce could lead to a 20-year liability that prevents David from reinvesting in his company or securing new equipment. This fear has contributed to the decline in marriage rates among high-asset-owning men in the 30 to 45 age bracket. In 2026, David utilizes a divorce insurance product known as a support capitalization policy. If his marriage dissolves, the insurance company pays out a massive lump sum that is held in a restricted trust for his children's expenses. This payout satisfies the bulk of his financial obligations upfront. From an actuarial standpoint, this transforms a volatile long-term liability into a fixed, managed monthly premium. For the U.S. economy, the potential outcome is significant. Instead of successful small business owners seeing their companies fail due to the cash flow drain of a divorce, the insurance company absorbs the shock. David's business remains a stable employer in the Denver area, and his children receive their support through a secure, non-litigious vehicle. This shift is creating a new corporate landscape. By mid-2026, we are seeing major tech and law firms in Silicon Valley and New York City offering divorce insurance subsidies as a standard part of their executive compensation packages. HR departments have realized that the productivity loss associated with a high-conflict divorce, estimated to cost U.S. businesses over $150 billion annually in absenteeism and diminished focus, is a risk that can be mitigated. If an employee has an insurance policy that handles the legal retainers and relocation costs, the recovery time for that employee drops by nearly 60%. This keeps the 35 to 55-year-old demographic, the peak productivity years for the American labor force, from being sidelined by domestic litigation. The demographic ripple effect also reaches the next generation. When we look at the children of these 2026 households, the statistical stability provided by insurance payouts is the difference between a child attending their first-choice university or being forced into the workforce early to support a single parent. Case studies from the first wave of insured divorces in the early 2020s suggest that children from insured splits have a 20% higher rate of college completion compared to those from uninsured splits of the same income bracket. This is because the insurance payout prevents the total liquidation of the college savings fund during the legal battle. We are seeing the rise of a generation that is not financially stunted by their parents' marital failures. Step by step, the gender and fatherhood shifts look like this. First, the introduction of insurance-backed career reentry funds encourages more high-skill women to return to the workforce after a hiatus, knowing they have a safety net. Second, the capitalization of child support through insurance payouts reduces the case backlog in U.S. family courts, which are currently overwhelmed with enforcement hearings. Third, the reduction in marital litigation leads to a 15% decrease in the use of high-interest predatory lending that many divorcees currently use to pay legal fees. This keeps more capital in the hands of the individuals rather than the debt servicing industry. Furthermore, we must address the rise of algorithm mediation. In 2026, many insurance providers are now requiring couples to use AI-driven mediation platforms as a condition of their policy. These platforms use big data to suggest equitable asset divisions based on thousands of similar case studies. If the couple agrees to the AI's suggestion, their insurance payout is fast-tracked. This is effectively moving the American divorce process out of the courtroom and into the private sector. It is a demographic transformation of the legal profession itself, as the need for traditional bulldog divorce attorneys shrinks in favor of insurance adjusters and financial planners. This raises a massive question about the future of the legal system. If the financial aspects of divorce are solved by an insurance check and an algorithm, what is left for the courts to decide? And more importantly, if we make divorce this efficient and financially stable, what happens to the social stigma that used to keep families together? Are we creating a society where the ease of exit leads to a total collapse of the long-term domestic unit? In the next part, we are going to look at the rise of the algorithmic prenup. We will explore how 2026 technology is allowing couples to simulate 10,000 different versions of their future before they ever say I do, and how these simulations are being used by insurance companies to set premiums. We are also going to look at the impact on the U.S. mental health industry. Is a society with less financial stress actually a happier society? Or are we just more effectively medicating the pain of transition with money? Stay tuned, because the intersection of artificial intelligence and human emotion is about to get very real. The intersection of artificial intelligence and human emotion becomes tangible through the emergence of the algorithmic prenup. In the United States of 2026, the traditional prenuptial agreement, once a static adversarial legal document drafted by high-priced attorneys, is being replaced by a dynamic, data-driven simulation. This is the era of the predictive union. For the demographic of 20 to 30-year-olds entering the marriage market, the question is no longer just whether they love their partner, but what their 10,000 iteration simulation says about their long-term domestic solvency. This shift is not merely a technological novelty. It is a fundamental restructuring of how marital risk is priced and managed by the insurance industry. Imagine James, a 29-year-old architectural designer, and Elena, a 31-year-old pharmaceutical researcher. In the spring of 2026, they are planning their wedding. Before they can secure a Tier 1 divorce insurance policy, their provider requires them to undergo a marital stress test. They upload their anonymized digital histories, career trajectories, geographic mobility patterns, health data, and even their historical spending volatility. The AI then runs 10,000 Monte Carlo simulations of their future. It accounts for potential outcomes like James losing a major contract in 2029, Elena being headhunted for a position in Switzerland in 2031, or the statistical likelihood of fertility challenges based on their shared biometric profiles. In 4,200 of those simulations, the marriage reaches a casualty point, a legal dissolution, before their 10th anniversary. The primary trigger identified is geographic career divergence. Because the risk is quantified at 42%, their monthly premium for a $150,000 payout is set at $285. However, the insurance company offers a risk mitigation discount. If James and Elena agree to a prehabilitation clause, which includes mandatory quarterly financial synchronization and access to an AI-driven communication coach, their premium drops to $190. This is the quantified relationship. For the demographic of young professionals, marriage is becoming a managed asset where the price of the safety net is determined by their willingness to adhere to data-backed behavioral standards. This level of granular underwriting is having a profound impact on the U.S. mental health industry. Historically, divorce has been cited as the second most stressful life event an individual can experience, surpassed only by the death of a spouse. This stress is not just emotional, it is physiological. Clinical data from the early 2020s showed that individuals undergoing a high-conflict divorce experienced a 400% increase in cortisol levels and were 3 times more likely to be diagnosed with clinical depression or anxiety disorders within the first 24 months of the split. This created a massive unaddressed burden on the U.S. healthcare system and a significant dip in the productivity of the 30 to 50-year-old workforce. In 2026, we are seeing a potential outcome where divorce insurance acts as an emotional liquidity bridge. When the financial trauma of a split is mitigated by a casualty payout, the brain is able to bypass the survival mode that typically accompanies domestic collapse. Because the insurance policy handles the legal retainers, the housing transition, and the immediate debt obligations, The individual is free to focus on what psychologists call integration mode. A 2026 study of insured divorcees in New York and California found that their recovery period, the time it takes to return to baseline mental health and professional productivity, was 55% shorter than that of their uninsured counterparts. Furthermore, many 2026 insurance policies now include a mental health transition rider. This isn't just a standard therapy voucher. It is a specialized fund that pays for transition coaching, career rebranding, and even neurological stress regulation treatments. For the American labor force, this means that the 35 to 55-year-old demographic stays in the game. We are avoiding the decade of despair that used to follow a midlife divorce. Instead of a 45-year-old manager spending 5 years in a state of financial and emotional paralysis, they are back to full professional capacity within 6 months. This resilience is a massive unquantified boost to the US GDP. Step by step, the mental health transformation looks like this. First, the simulation phase removes the shock of the split. Because the couple has already seen the 10,000 versions of their future, a divorce is no longer viewed as a personal failure, but as a statistical casualty that was always a possibility. This reduces the stigma and the associated shame. Second, the automated mediation platforms used by insurers prevent the adversarial escalation that usually happens in a courtroom. By removing the fight, they remove the trauma. Third, the immediate liquidity allows for the maintenance of separate but stable environments, which is the single most important factor in the mental health of any children involved. However, we must address the demographic of the simulation sufferers. In 2026, there is a growing segment of the under 30 population that is experiencing simulation paralysis. These are individuals who are so terrified by their high-risk marital scores that they are opting out of relationships entirely. They are the never-married demographic, and they are growing at an alarming rate in high-tech urban centers. If the algorithm says you have a 70% chance of failure, do you even start? This is the dark side of the data. We are creating a generation that is overinsured and underattached, trading the potential for deep human connection for the certainty of financial protection. This leads to a fascinating shift in the U.S. housing and leisure markets. We are seeing the rise of the insured single demographic, individuals in their 30s and 40s who have a high net worth, a high marital credit score, but no spouse. They are using their divorce insurance premiums as a form of specialized savings, knowing that if they do marry and fail, they are protected, and if they never marry, they have a massive pool of capital for their later years. They are the new architects of the American economy, driving a surge in high-end, single-occupancy real estate and solo travel industries. As we analyze these shifts, we are forced to ask, is this the ultimate evolution of the American dream? Have we finally conquered the volatility of the human heart by turning it into an insurable risk? Or have we just created a more comfortable cage made of data points and premium payments? The demographic stability we are seeing is undeniable, but the social cost is still being calculated. We are witnessing the birth of a society that values resilience over romance and liquidity over longevity. But there is one final piece to this statistical puzzle. As the private insurance market takes over the role of the family court, the U.S. government is facing a crisis of authority. What happens to the law when the algorithm is the judge, the jury, and the executioner? We are about to enter the final part of our deep dive masterclass, where we look at the ultimate conclusion of this trend. We are going to reveal the projected U.S. population map for the year 2050 and show you exactly how divorce insurance will determine which states thrive and which ones face a demographic collapse. Stay tuned for the final part because the global power balance is about to shift, and it all starts with a marriage certificate. The shift in global power is fundamentally a shift in demographic resilience. By the time we reach the midpoint of 2026, the United States is witnessing a massive internal migration that is being driven by what economists are calling domestic protection zones. To understand the projected U.S. population map of 2050, we have to look at how individual states are competing for the most valuable demographic in the world, the 25 to 45-year-old tax-paying, child-rearing professional. Historically, state-to-state migration was driven by income tax rates and job availability. But in 2026, a new variable has entered the equation: the legal and financial environment for marital risk management. Consider the case of Ethan and Chloe. Ethan is a 33-year-old cybersecurity analyst, and Chloe is a 31-year-old occupational therapist. They currently reside in a high-tax state in the Northeast where the family court system is notoriously slow, adversarial, and expensive. In their current jurisdiction, the legal precedent makes it difficult for private divorce insurance products to offer competitive premiums because the court-mandated division of assets is so unpredictable. For Ethan and Chloe, the risk premium of starting a large family in this environment is too high. They are part of the demographic of the paralyzed middle. However, in 2026, states like Texas, Florida, and Tennessee have passed the Marital Innovation Acts. These laws recognize divorce insurance as a primary casualty product and offer tax credits to couples who maintain a high level of coverage. More importantly, these states have created fast-track domestic courts that defer to the mediation and payout structures established in the insurance contracts. Ethan and Chloe look at the data and see a potential outcome that is undeniable. By moving to Austin, Texas, they can secure a divorce insurance policy that is 30% cheaper than in their current state, with a payout that is legally protected from traditional litigation. This is the great domestic sorting. By 2030, we expect to see a massive brain drain from states that cling to the old high-conflict marital models. The states that thrive will be those that create an insurance haven for the family unit. Statistically, this leads to a demographic restacking. The insured states will see a surge in the under 40 population, a stabilized birth rate, and a robust real estate market. Conversely, the uninsured states will face a demographic collapse, characterized by an aging population, a shrinking tax base, and a youth exodus, as young professionals flee to jurisdictions where their domestic life is treated as a managed risk rather than a legal liability. Now let us zoom out to the global stage. The 21st century is defined by the demographic winter. Nations like Japan, South Korea, and much of Western Europe are facing a catastrophic decline in population because they have failed to solve the risk premium of the family unit. In South Korea, the fertility rate has dipped below 0.7, a level that points toward total societal dissolution. Why? Because the financial and social cost of marriage and childrearing has become a certain loss in the eyes of their youth. The United States, by contrast, is pioneering the privatization of marital stability through divorce insurance. If this model reaches a 60% adoption rate by 2040, the U.S. will be the only developed nation to successfully de-risk the family unit. This creates a permanent competitive advantage. While China and Europe are forced to divert massive portions of their GDP to care for an aging, unsupported elderly population, the U.S. will have a re-thickened age pyramid. The insurance generation, those born to parents who felt the financial safety to have 2 or 3 children, will enter the workforce in the 2040s and 2050s with unprecedented generational wealth. Step by step, the global power shift looks like this. First, the U.S. attracts the world's most talented young professionals not just for the wages, but for the domestic security offered by the insurance legal hybrid system. Second, the preservation of generational wealth through insurance payouts leads to a superproductive labor force that isn't burdened by the debts of their parents' divorces. Third, the U.S. maintains its role as the global consumer engine because its households remain liquid and stable through midlife transitions. This is how the American century is extended. It is not through military dominance, but through the actuarial stabilization of the home. The 2050 census data is projected to show a United States that looks radically different from the projections made in 2020. In the insured-heavy regions, the average age will be lower, the homeownership rate among 30-year-olds will be higher, and the wealth chasm that currently separates the married from the divorced will have significantly narrowed. We will see a society where the family unit is no longer a fragile, all-or-nothing gamble, but a modular, insured, and resilient economic engine. However, this masterclass would not be complete without looking at the final, most controversial statistical outcome. As we reach 2050, the very nature of human commitment will have changed. We are moving toward a society of actuarial honesty. In the past, we relied on social stigma and religious pressure to keep households together, a model that failed as soon as those pressures evaporated. In the future, we will rely on a sophisticated system of financial incentives and risk management. Is this a colder world? Perhaps. But it is also a more stable one. By removing the financial terror from the end of a relationship, we actually allow the emotional aspects of the relationship to be more honest. People stay because they want to, not because they are financially trapped. And when they do leave, they leave with the capital to remain productive members of society. This is the ultimate demographic stabilizer. In this 10-part deep dive, we have moved from the initial shock of the divorce insurance concept to a full-scale analysis of its impact on housing, gender, labor, mental health, and global power. We have seen how a single financial instrument, when applied at scale, can reverse the aging of a nation and protect the wealth of generations. We have seen how the year 2026 was the pivot point where the American household stopped being a casualty of volatility and started being an asset of resilience. The data is clear. The trend is accelerating, and the world is watching. The American experiment is entering its next phase, one where the pursuit of happiness is finally insured against the risks of reality. But as we conclude this masterclass, one final question remains. If we can insure against the failure of a marriage, what is the next frontier? As we move into the 2030s, the insurance industry is already looking at something even more radical: the career volatility hedge. What if your ability to survive the total displacement of your industry by AI was also a part of your domestic insurance policy? Stay tuned to this channel, because we are already preparing our next deep dive masterclass on the rise of the career-less class, and how the 2027 Universal Basic Insurance Act will determine who survives the next decade of technological disruption. The future is coming faster than the algorithms predicted. Make sure you are subscribed, because the next breakdown is going to change everything you thought you knew about the value of your own labor. We will see you in the next series.